playing your theme song there, Greg.
Awesome. All right, everyone, good morning. Thanks for attending. Stefan politely said I spent 30 years in credit trading. Very simply, credit runs the world. Okay, you may like to look at equities for signs, but you have to look at credit markets. Credit runs the world. And I'm pleased to be joined by 3 experts who are going to talk about that. But I want you to remember one thing. First, study mathematics. This hat says it's only math. Do the math, okay? Understand what we're talking about today. The title is Avoiding the Debt Spiral. I'd like to massage that a bit to understanding or managing the debt spiral. So the first thing that we need to understand is what is the debt spiral. I'm going to turn that over to my friend James Lavish to give a brief definition of the context of the debt spiral that all federal governments, not just the USA, all federal governments find themselves in.
Thank you, Greg. So first of all, happy Friday, and I'm sorry I'm about to ruin it for you. So what is the debt spiral? Well, Greg and I talked about this about a year ago, and he encouraged me to write an article about it to let people know exactly what the position is of the United States government and many of the sovereigns around the world. But basically, the debt spiral, if you were looking at the United States Treasury and you considered it, if you were looking at it like a company on the New York Stock Exchange, we would call it a zombie company. Now, what do I mean by that? Well, it means that the company isn't covering its interest expense with its earnings, okay? So if you look at the United States Treasury, and we look at all of their expenses, you have mandatory expenses like the Social Security, Medicare, Medicaid, and then those are signed into legislation. They have no choice. They've got to pay these expenses, right? Then you've got big expenses that are signed into long-term contracts like the defense spending. When you add those up and you add interest expenses on the debt, they total more than the United States Treasury takes in earnings, which is really just tax dollars, every year. So that creates a deficit. And in the United States, we've been operating in a perpetual deficit for a very long time. And so that deficit leads to us having to borrow more to cover the deficit, which is issuing bonds. And then you have to pay interest on those bonds, and then you have to, that interest that you're paying now creates a larger deficit. And as that deficit grows, it creates a larger interest expense, which creates what? A larger deficit. And eventually it creates the demand for treasuries to fall, which means that you're going to have to pay more interest on that, and as interest rates are rising, you're paying even more interest on the debt that you're issuing, which creates what? A larger deficit, and this is called the
debt spiral. So, eloquently put, James, people would argue, well, don't worry. The economy is growing just as fast as the debt is. That's false. Total debt to GDP is a very important metric because total debt gets paid by tax revenue on GDP, right? So you have a numerator, total debt, you have your denominator, GDP. The fact of the matter is that your total debt is growing faster than your sales growth or GDP. Larry.
Yeah, so in 2008, when John Law was running the Federal Reserve, Ben Bernanke was running the Federal Reserve, things changed. And the U.S. national debt since that date has grown at a rate of 8.5%, and the GDP has grown at a rate of 4%. That's the fundamental problem. The GDP is necessary to pay the interest on the debt. And so the Keynesian experiment, as we know it, it's toast. It's all over. These guys have been lying. We know it. They know we know. And we're about to put them in their grave.
So if you want to put a number on it, I'm going to turn it over to Preston here, but if you want to put a number on it, that the United States added $500 billion of debt in the last 2 weeks. So now we have borrowed $33.5 trillion. So we just crossed $33 trillion, and we just added another 500 to it in 2 weeks.
I just want to put context on that number. So we hear these numbers, 500 billion in the last 2 weeks. And for most people, they're just like, oh, that sounds like that's a really big number. If you look at the Department of Defense, they spend, what, 700, 800 billion in a year, okay? We have added 500 billion, almost that same amount in the last 2 weeks. So to really like wrap your head around these numbers, think about the meme when people post on Twitter of like the aircraft carrier going through the sea with the fighter jets and all the training and all the personnel and all the bases. You go to Texas, there's a road at Fort Hood. It's 7-8 miles long with tanks for 7 or 8 miles. To fund all of that, the people, the material, the R&D, all of it, $700 billion. We've added $500 billion in the last 2 weeks. So when you're trying to wrap your head around like the magnitude of these numbers, you have to think in terms of the context of what this is. And when we talk about the interest rate, what are we looking at for the interest rate in the coming year right now? It's over $1 trillion?
Oh, so if you're looking at just the interest expense, last year it was about $600 billion. This year it's just under $1 trillion. So it's like an 80% rise, or at least a 70% rise, but it's going to be close to 80% rise in the interest expense in 1 year.
So you're to service just the interest, not any productivity, not anything, right? Just the interest is exceeding the budget of DOD and all of that spending that's taking place, to kind of wrap your head around where we're at.
They borrowed $500 billion in 2 weeks. That's the entire market cap of Bitcoin.
So let that sink in. They borrowed the entire market cap of Bitcoin in 2 weeks. Size or context is always important, and sometimes people lose the context in the big numbers. But let's not rein it in. But
Greg, real fast, one point to this. We're talking about the best fiat currency in the world right now. This is the best one. The rest of the world is dealing with, like, this thing's only debasing, or at least it's only debased over the last 10 years based on the compound annual growth rate of like 7 or 8%. That's the best one that we're talking about. Everything else is worse than that everybody else in the world and the planet is dealing with, just to put it in context.
So we talk about event horizons and whether we're approaching an event, whether we're in an event. So today was the jobs number. I don't know if people saw it. And initially, when it was announced, the U.S. Treasury 10-year note spiked up 12 or 13 basis points to a new high of about 4.85%. This is a new high yield in the U.S. 10-year note since 2007-ish. But as these rates go higher, obviously when the Treasury refunds or rolls over their debt, they have to pay higher rates. So therefore, the debt spiral accelerates. Let's talk about that.
So fundamentally, what we have here is a sovereign debt crisis, and the United States is starting to look like a third world country. You know, we've seen this pattern before. This is not new. We've never seen it in the world's reserve currency, which is what we have here, but we've seen it in Argentina, we've seen it in Venezuela, we've seen it in Zimbabwe, we've seen it in Weimar, you know, time and time again. And the fact of the matter is that as deficits continue to grow, the bond market feels the stress of that as we have to issue more debt, interest rates go up, and there's no way out. I mean, these people, the people who run the Fed, are completely, totally, and utterly fucked. They are going to lose this battle, and the currency is going to ultimately become worthless. And you can kind of see that. I mean, in Powell's most recent presser, he said he's navigated under cloudy skies with a sextant. I mean, dude, we got GPS. I mean, what the fuck? You know, I mean, the guy has no clue what he's doing, and you're seeing him start to indicate that they're going to have to pivot. And I think in terms of an event horizon, we're all of the belief that that pivot has got to come fairly soon.
So that pivot would indicate resumed QE. I like to say QE infinity is inevitable. But with resumed QE, what you have is accelerated fiat debasement. Now, everyone needs to understand that the US 10-year note basically sets rates for the rest of the world. So what happens in the USA impacts the rest of the world. And it's those other secondary and tertiary fiats that get really, really hurt. So we can look at Bitcoin price in US dollars, but sometimes I encourage you, I'm a Canadian, a G7 country. Canada is a G7 country with an economy that's smaller than the state of California's economy. You guys are very lucky to live in the United States. It's a beautiful, integrated economy, but it sets rates for the rest of the world. And sometimes when the USA catches a cold, everyone else gets very, very sick. So we have to understand the context on a global macro basis. Over to you, James.
Yeah, so something that's really important to understand is we keep talking about QE and how the Fed's going to pivot, they're going to provide liquidity to the market. This is all, the reason why they must do that is exactly what we're talking about. The Treasury must have a market that will buy Treasuries. It must stay liquid. It absolutely has to have a place to dump all of these Treasuries. And you're seeing the rates of the Treasuries rise on the long end, looking for price discovery on where these rates are going to go, because they know that the Fed or the Treasury has to have a market for them. It cannot break. So when we talk about QE, quantitative easing, what we're talking about in simple terms is the Treasury pushing a button, putting a bunch of money on the Fed's balance sheet. The Fed tells Citigroup and JP Morgan to go buy a bunch of bonds in the market. We're going to buy them back from you today. The Fed gives them the money and then turns around and holds the Treasuries on its balance sheet, right? So that's QE. They're literally monetizing the debt. And we've seen this happen in Japan, where Japan owns, the Bank of Japan is the largest owner of its own debt. Think through that for a second. They own more than 50% of its own debt. So that's where we're headed as a country. And so, but that's when we talk about QE, we talk about having the Treasury come in to save the market with the Fed, because it must have that market.
And as Greg says, it's just math. And historically, we've seen this many, many times. We saw it in 2008. We saw it in the repo crisis in 2018. We saw it in March of this year. I mean, the Fed actually arguably already has pivoted. BTFP was a small pivot. And so we know that their third mandate, their two mandates are obviously full employment and inflation. They failed at inflation, obviously. We know their third mandate is keeping the system functioning, and every time it doesn't function, they do the exact same thing, which is they pivot. And I want to just read three headlines. These are just from yesterday. Nick Tamaros in the Journal: if the bond market keeps this up, the Federal Reserve will have less of a reason to hike rates again. Wonder what that means. Wall Street Journal headline yesterday: rising interest rates mean deficits finally matter. Bond sell-off might force the Fed to rethink shedding assets. What does that mean? Okay. Breaking markets, Fed's daily. With the rise in bond yields, the need to do additional tightening by the Fed is not there. What does that mean? These fuckers are going to print. They're going to print until their fucking eyes bleed. And we know it's going to happen. And so all we've got to do is outlast them and then watch them as they suffer.
I like sitting on stage with... It's great to be on stage with Larry Lepard, because Foss doesn't look like such a swearing imbecile, okay? So let's hear a bit more from Preston, though. Preston has some excellent takes on the credit markets, and we were talking in the back room, Preston. We got to look at what signals markets are giving us. And the US 10-year rate I talked about hit 485, but there's other things that are very concerning, including the debt maturity profile of the United States Treasury. Let's talk about that a little bit. What happens when short-term bonds that are rolling over in the short term need to get refinanced at these higher rates? Wouldn't you have thought that the Treasury would have, when rates were really low, extended their maturity profiles so that we had a lot of outstanding debt? No, they didn't do that. So,
yeah, I think it's, what's the number, like 45% of the debt, of the U.S. debt, has to be rolled in the coming 12 months.
18 months.
Just to say that again?
isn't it 3 years?
3 years, okay. So it's happening quickly. The amount that they're going to have to do to roll that over and the higher interest rate that they're going to have to do it at only compounds the numbers that we were throwing out there as far as what the interest expense looks like in the coming year. Something else that I think is a really, when you're looking at credit markets and you're looking at yield curves and you're trying to understand what the market's telling you, credit is just, these traders like Greg, when they were pricing bonds, the first thing they're asking themselves is, what is the inflation rate? Is it 3%, 4%? And then what kind of premium can I get on top of that? Well, the bond needs to be yield. If inflation's 4%, well, the bond needs to be paying me like 6% for me to outpace that and for it to be something that I would actually want to own, especially if I want to own it long term. When we look at what's happened over the past 12 months, we've had a disinflationary, where the inflation is slowly, the print's coming down. Prices are still going up, but the rate at which they're going up is coming down from where it was 12 months ago, which means you would expect to be getting a bid in credit markets, but you're not. Credit markets are still selling off. They're still going higher. And so what is that signal telling you? It's telling you the people are finally doing the math. You know, James wrote about this debt spiral a year ago, and people would look at him and be like, well, who's this guy, and what's he talking about? He's wearing a tinfoil hat. But all of a sudden, he's not the one wearing the tinfoil hat. Everybody on Wall Street is now doing that same math, and that's why they're selling the long end of the yield curve, even though we have a quote-unquote disinflationary impact happening, because everybody knows that that's only going to play out for a couple more months or a year before what Larry's describing comes to fruition and is a reality. People are finally doing the math. They're figuring it out. The credit markets are screaming that to the public, whether you want to see it or not in the price action.
Right, and so as this debt rolls off, people are saying, well, okay, well, we're going to hit a recession here at some point, and then the interest rates are going to come down, and it's going to all be fixed. But actually, that doesn't really solve the problem of earnings, because we've already seen the Fed has put out, the Treasury has put out that earnings, tax receipts this year are down 10% already from last year. So what happens when we hit a recession?
That's a really big deal. You're down 10% when you're pretty much at the peak of this cycle, right?
Yeah, so
which is unheard of.
Yeah, so we hear the unemployment rate's low, everything's great, but yet at the same time we hear corporate bankruptcies are going up, right? Which means that profits are tightening, right? So you're getting lower margins. So that means that you're going to have layoffs. But just remember this thing. Remember that when you see a recession, that's when unemployment spikes. Unemployment does not give you an indication you're going to get into a recession. That means you're in it. So every time you hear the Fed say that, oh, unemployment's still low, everything's great, no, it's going to spike after it's too late, and this is part of that perpetual problem. So what they're going to do is they're going to break the market, because the only thing the Fed can do is tighten enough until we just squash demand and cause that big spike in unemployment, the drop in spending. But what does that do? It perpetuates the need for the United States to borrow more money. And so what does that lead to? QE and infinity. They're going to print so much money it'll make your face melt.
I was just going to say, so historically, it would take about 18 months for this lag effect to take place, where they've paused, and then it takes 18 months for a lot of those effects of these higher rates to like percolate into the economy. I kind of think that the amount of stimulus that they're going to have to do on this incoming deflationary collapse that's going to take place, they're going to have to flood liquidity into the masses, similar to what they did during COVID. I'm curious if you guys see it similarly, And I don't even know that that lag effect of 18 months is going to take place, because I think the need for UBI and some of these other activities to push liquidity into people's hands is going to be so desirable that you're going to have social unrest unless you act in that way. And I'm curious if you guys have a similar opinion to that.
Yeah, I mean, if you look back and if people talk about the 1980s and Volcker, where he raised rates up to 18, 20%, just say, well, we could just do that. Well, obviously we can't, because now you all understand that we have a debt problem, right? But we've become addicted to this stimulus because we have so much debt. And that's the great issue. And Greg, if you could explain what a credit event is for everybody, because that, I think, is where we're headed. We're going to have a big credit event that causes this spike down in everything, and then the Fed needing to step in with the Treasury and rescue the market.
Well, as I said, credit runs the world. I've been through 4 credit events in my history. Started with Latin American debt. Next was long-term capital management. I won't run through them, but everyone is different. As Jeff Booth often says, you never know which snowflake causes the avalanche. But typically, we were talking backstage again, it could be a large hedge fund that gets obliterated and taps out. There's been rumors lately in the U.S. Treasury market, the price action in the long bonds has indicated that someone got carted off the floor. You don't know what specific event will trigger it, whether it will be high-yield bonds, whether it will be a sovereign nation, whether it will be some sort of leveraged fund blow-up like long-term capital management. But generally, they are based around the credit markets, as I've said. So you can measure this in credit default swaps. I don't want to get too granular, but I will end the panel with a very important metric. But over to Larry and Preston to see what they think.
Yeah, my view is that a lot of things are all going to break at once. The economy is going to hit the wall. The small and regional banks, we know there's $600 billion of losses in the small and regional banks. You know, they were very close to losing control of the whole thing in March when Silicon Valley Bank went down. I mean, they thank their lucky stars that the BTFP worked and that, you know, Aunt Janet was able to bluff everybody into believing that they would cover all the deposits, because there's $17 trillion in bank deposits. The FDIC cannot cover that amount. But those banks are still hurting. I mean, 50 to 60% of the banks probably have negative equity right now. And, you know, wait until the wages from all these labor movements start to flow through the earnings statements of all these companies. I mean, I feel terrible for these people who are striking. I understand why they're striking. The strike is they're getting roasted by inflation, but they're about to lose. They're about to realize they got a bigger problem than inflation. They're about to lose their job because the companies are going to fail, and then they're going to be out of work. I mean, guys, I mean, sadly, this is going to be an unbelievable shit show, in my view, in the next 12 months. And my sense is that politicians are going to respond the way they've always responded, which is to cover their own ass, to try and protect their own ass. And the lowest hanging fruit, the easiest way for them to do it is going to be to chop rates and send out UBI. And to answer your question, Preston, I think it's going to be unbelievable. I think the Fed balance sheet is going to 20 trillion on the next cycle. They're going to have to, because once again, you know, they're steering this car between these guardrails of too much inflation and too much deflation. I mean, we've got negative M2 growth today. We haven't seen that since 1930, which was the Great Depression. And so if they think they can do the same thing and not have the same result, good luck. It's going to be a mess.
So I guess I would say, I think in the coming 12 months, we're going to be, as Bitcoiners, going to be kind of surprised at some of the things that we see. In particular, I think one of the things that's going to surprise us most is I think you're going to actually see a large bank, call it Fidelity, BlackRock, or whatever. I think they're going to I think the ETF's going to get approved. I think you're going to see one of these large banks actually start to recommend Bitcoin as a percent of the standard portfolio for people. And I know that sounds crazy for people listening to that. I think that's happening in the coming 12 months, where I could see a BlackRock say, we think it's appropriate for 1% of a person's portfolio to be in Bitcoin.
Oh, and by the way, we have this ETF for you.
And we have this ETF vehicle for you to do it, which I don't think anybody should invest in. I think they should self-custody, buy their own Bitcoin, hold their own keys. But I think that it's their only hope out of this. I think there's people on Wall Street that are actually able to do this math. I think they're somewhat starting to see what the value prop of Bitcoin is, in that it actually provides salvation to this disastrous scenario. And I'm very hopeful that that it'll be hopefully enough to kind of bridge this transition. And I think hang on to your hats, because I think the next 12 months for Bitcoiners is going to be one hell of a ride.
So what we did, four clowns over the age of, Preston's the youngest, I don't know how old you are, but four clowns with
he's just a millennial.
With an age averaging, I'm going to say 57. No, yeah, 57-ish, okay?
You two must be really old.
We have 30 slides. We have 30 slides that we put together. Larry has them in his lap here. But then they told us, you're not smart enough to operate a monitor, okay? Which is me. So all of these slides are under Larry Lepard's Twitter handle. Please look at them and try and understand some of the mathematics that we're referencing here. This is scary stuff, but it's education. It's not, we're not making these numbers up. These are grade 11 mathematical equations. We have 3 minutes left. We're going to try and summarize any points here, panelist by panelist.
So really quickly, when we talk about QE and we talk about printing so much money your face melts, well, what we're talking about is the need for the United States, for the Treasury to continue to have inflation, to have a higher GDP number on nominal terms, meaning just more money to tax, higher tax receipts to pay down all that debt that they're issuing. So what does that mean? That means that there's going to be asset inflation. If they create all this money, then you want to own things like Bitcoin, because that cannot be inflated. That will be your ultimate hedge against this disaster scenario where they print so much money that your eyes bleed.
I don't have anything else to say. I know we're short on time.
Yeah,
so
I really don't have much to add either. I think that everybody's here obviously understands the issues and the problems. A lot of people ask when, and none of us know when. It feels to me like we're in it right now with what the 10-year is doing. I'd be shocked if it takes more than a year for this thing to come unglued and for them to have to pivot massively. Shocked. But I've been wrong a lot. So I think by 2030, the dollar is worthless. We've got full-fledged hyperinflation.
So thank God for Bitcoin.
Yeah, thank God for Bitcoin.
I have an expression, all I bring to the table is 35 years of mistakes. Don't let your mistakes kill you, though. Our good friend Lynn Alden, in Larry's chart, chart number 4, page 4. Fiat debasement is 100% certain. When you're given a certainty of an outcome, you need to protect yourself. Very few things in finance are 100% certain. Fiat debasement is 100% certain. Hence, own hard assets. What's the best hard asset? Here's a shout out to Swan. You guys know they have this brilliant CIO. His name is Hoffa. He put together something called the NakamotoPortfolio.com. It's an open source platform that measures, or it gives you the ability to analyze anybody's portfolio to see how much Bitcoin should be in that portfolio to optimize Sharpe ratios, a way of saying what is the best way to increase return and maintain the same level of risk, or reduce your risk and keep the same level of return. Hoffa was kind enough to put my CDS model on the portfolio, which values Bitcoin using credit default swaps on sovereign nations around the world. One of my slides, the only one, was to show the value of Bitcoin according to the NakamotoPortfolio.com. I can't show it to you, but on that methodology, in today's numbers, Bitcoin's worth over $300,000 US per coin. And that's before we've hit the credit event. That's just using open market rates. Guys, learn mathematics. It's that simple. Manage risk accordingly. Buy Bitcoin for the kids. Thank you.